guys, welcome to Talking Money with Nosy, personal finance made simple. Today I'm going to be talking about how you can build a monthly dividend portfolio on the JSE, the Johannesburg Stock Exchange. Guys, I'm going to say this until kingdom come. If you are a long-term investor, you need to choose companies based on stability, profitability, and sustainable dividends. Never invest in shares based on the dividend only. Always check that the company has growing revenue, growing net income or profits, low debt, and increasing free cash flow. And as always, I prefer to have a mixture of ETFs and shares in my portfolio with a higher allocation of my money going to ETFs. So where do you start looking to build your monthly dividend portfolio? First, make a list of companies that you know and understand. As an investor, you should understand what a company sells, how it makes money, and who its competitors are. Remember, when you are buying shares, you are not buying numbers on a screen or on a graph. You are actually buying pieces of businesses, and therefore it is important for you to understand the businesses that you are buying. Personally, I would look at the top 40 companies first. Luckily, Easy Equities has a function where you can see all the top 40 companies in 1 or 2 pages.
Guys, this is my Easy Equities account. I logged in using the website. So if I click on equities under ZAR, then under category tags, select top 40. All these companies that you see here are the top 40 companies. Where it says show, let me select 48. So these are all the companies that are in the top 40. So I would start doing my research on these top 40 companies.
Secondly, shortlist the companies that have strong competitive advantages. A strong competitive advantage is a characteristic that puts a company in a better business position compared to its competitors. Why should you go for companies with strong competitive advantages? Well, it's because strong competitive advantage equals long-term profitability equals stock price growth. Companies with strong competitive advantages will most likely be around in the future and not get beaten by competitors. All businesses experience ups and downs, but a company with a strong competitive advantage is usually more resilient and can survive recessions as well as economic downturns. An example of a company with a strong competitive advantage is the Coca-Cola company, which is on the US stock market. What makes it have a strong competitive advantage? Well, the Coca-Cola company is the largest non-alcoholic beverage company in the world. It sells more than 1 billion drinks in more than 200 countries every single day. The company currently has over 400 different brands under its control, and it is one of the most recognizable brands in the commercial world. Everybody knows Coca-Cola, right? Unless if they're living under a rock. So using the same concept, go through your list of companies and try to identify what type of competitive advantages each company has. Scratch out any companies that don't have any competitive advantages. The third step is to check the company's profitability and financial health. Some investors don't know or they forget that shares on the stock market are not independent of the state of the business in real life. The growth of your shares depends on the financial health of the business. If a business is losing money and accumulating mountains of debt, there is no way that those shares of that business will grow consistently over the long term. And it doesn't matter how much you hope, how much you pray, and how much you fast. On the other hand, if a business is well run and it improves financially year after year, then the shares will also grow. In the short term, the share prices of good businesses can swing up or down, but over the long term, the growth in share prices reflects how the business is doing in real life. When it comes to the financial health of a company, the most important things to look at are the balance sheet, the income statement, and the cash flow statement. My ebook goes through the details of how to choose shares and what to look for in those 3 financial statements. You can get it from my online store. Just click the link in my description below. Let me do a quick scan of Kumba iron ore to show you what I look for when I am choosing shares.
Okay guys, I'm going to show you how I do analysis on a stock using Kumba Iron Ore. Kumba Iron Ore is such a brilliant example. Of course, this is not a recommendation, it's just to show you how I do my analysis. So I use Yahoo Finance. This is my go-to when I want to do a quick scan of a company. Just go to Google, type Yahoo Finance, and then click on the link that appears. The other website that I like to use hand in hand with Yahoo Finance is Simply Wall Street. So you type in simplywall.st and it'll come up and show you the South African market. Back to Yahoo Finance, where it says search for news, symbols, or companies. I'll type Kumba Iron Ore. Then this is what I want to click on. Under Simply Wall Street, I'll also type in Kumba and select Kumba Iron Ore. Now let me start with Yahoo Finance. I want to click where it says financials because I want to check the financial health of the company. So under the financials tab, you will see 3 tabs. There's the income statement, the balance sheet, and the cash flow statement. So let's start with the income statement. What does it show us exactly? So the income statement shows us the revenue, which is how much money does the company make from selling iron ore. So you will see it shows you from left to right, which is 2018 to 2021. What you want to see is that the revenue must be increasing over the years. Starting in 2018, you can see that the revenue for Kumba was 45.7 billion rand. Then in 2019, 64.2 billion rand. Then in 2020, 80.1 billion. And then in 2021, the revenue was 102 billion rand. All well and good. But then there's the cost of revenue, right? We all know you need to spend money to make money. So it's the same for companies as well. Total revenue minus cost of revenue gives you gross profit. So you want to see the profits increasing over the years. Again, starting from 2018, gross profit was 33 billion. Then in 2019, 46.9 billion. Then in 2020, 65.9 billion. 2021, 97.7 billion. The other thing that you're going to see in the income statement is the earnings per share. What is earnings per share or EPS? Earnings per share is calculated by dividing a company's profit by its total number of shares. Earnings per share or EPS is an indicator of a company's profitability. EPS indicates how much money a company makes per share. Starting in 2018, earnings per share was 30. Then 2019, earnings per share was 50. Then in 2020, earnings per share was 71. Earnings per share for a company must increase because then you can see that the company is growing in terms of profitability. So you can see that there has been progress over these 3 years. There's nothing yet for 2021. Perhaps that information is not yet out. Next, you click on the balance sheet. What does the balance sheet show you? The balance sheet shows you what a company owns versus what it owes at a point in time. It shows you assets versus liabilities. Assets are things that a company owns that have value. These are things which can either be sold or used by the company to make products or provide services that can be sold. Assets include physical property like trucks, equipment, etc. It also includes things like trademarks and licenses. Even cash is an asset. Liabilities, on the other hand, are amounts of money that a company owes to others. This can include things like money borrowed from a bank, rent money, money owed to suppliers, money owed as taxes to the government. And then equity is also known as net worth. The difference between assets and liabilities is the equity or net worth of the company. It's the money that would be left if a company sold all of its assets and paid off all its liabilities. This equity or leftover money is the money that belongs to shareholders or the owners of the company. So what you want to see is the equity must increase over time. And as you can see, 2018 equity was 46 billion, then in 2019 47 billion, then in 2020 62 billion, then in 2021 a slight drop, 58 billion rand. Now, as I said, I use Yahoo Finance in conjunction with Simply Wall Street. So if I click on Simply Wall Street and go to health, the financial health of the company, you can see here the assets are broken down into short-term as well as long-term assets. Same with the liabilities. They're also broken down in terms of short-term liabilities as well as long-term liabilities. And what you can see is that the short-term assets for Kumba, it's 32 billion, whereas the short-term liabilities are 10 billion. Basically, the assets in the short term can cover the short-term liabilities 3 times, right? Similarly, with your long-term assets, they're 49 billion, whereas the long-term liabilities are 13 billion. So the financial position of Kumba is very, very healthy because it says that the short-term assets exceed short-term liabilities. Same thing applies for the long-term assets and long-term liabilities. The next thing that we have to look at is the cash flow statement. What does the cash flow statement show you? The cash flow statement reports the cash coming in and going out of the company. Cash flow is important because a company needs to have enough cash to pay for its expenses as well as to buy assets. Cash flow statements are divided into 3 main parts. We've got number 1, the operating cash flow. Number 2, investing cash flow. And number 3, financing cash flow. Operating cash flow shows the actual cash the company received from or used in its operating activities. This must be positive and it must be increasing over the years. So operating cash flow in 2018, 15.2 billion, 2019, 27.3 billion, 2020, 30.6 billion, 2021, 48.9 billion. So there's growth in the operating cash flow. Investing cash flow shows the cash flow from all investing activities, which include buying or selling of long-term assets like property, plant and equipment, as well as investments. If a company buys machinery, the cash flow statement would show this as a cash outflow from investing activities because money went out of the company. If the company decided to sell some investments from an investment portfolio, the money from the sale would show up as a cash inflow from investing activities because money came in to the company. Then thirdly, we've got that financing cash flow. Financing cash flow includes cash borrowed from banks, cash used to pay dividends, or cash used to pay back loans. The most important thing in the cash flow statement is the free cash flow. Free cash flow is the money a company has left over after paying its capital expenditures. Operating cash flow minus capital expenditure, then you get free cash flow. A company with a positive free cash flow can pay its bills each month and have some money left over. Businesses with rising or high free cash flow numbers are usually doing well and can expand, can grow. So clever investors love companies that produce plenty of free cash flow because it shows a company's ability to pay debt, pay dividends, buy back shares, and help the growth of the business. Without free cash flow, it's tough to develop new products, make acquisitions, pay dividends, and reduce debt.
Lastly, before I show you my example of a monthly dividend portfolio, I would like to mention that I prefer to look at large cap dividend stocks with a market capitalization of 10 billion rand or more first. What is market cap or market capitalization? Market capitalization measures what a company is worth on the stock market. It is calculated by multiplying the price of a stock by its total number of outstanding shares. For example, a company with 20 million shares, each selling at 500 Rand per share, would have a market cap of 10 billion Rand. Market capitalization is important because it allows us as investors to understand the size of one company compared to another. Large cap companies are usually companies with a market value of 10 billion Rand or more. These large cap companies are also known as blue chip companies and have a reputation for high quality goods and services, have a history of consistent dividend payments, and steady growth. They are often found in well-established industries and most of their brand names are familiar to consumers. Large cap stocks may be considered more conservative and lower risk, compared to mid-cap and small-cap companies. Mid-cap companies are businesses with a market value of between 2 billion and 10 billion. Usually, these are established companies in industries experiencing or expected to experience rapid growth. Mid-cap stocks generally fall between large caps and small caps on the risk versus reward spectrum. Small cap companies are typically those with a market value of between 300 million to 2 billion. Generally, these are young companies and are considered to be the most aggressive and risky of the three categories. Small cap companies have limited resources, which makes them more vulnerable to business and economic downturns. They are also vulnerable to intense competition as they try to establish themselves in the economy. Usually, small cap companies do not pay dividends. Now that I have defined what market cap is, let me show you an example of a monthly dividend portfolio made of large cap companies as well as 2 ETFs.
This is an example of a dividend portfolio that would pay you dividends from January to December. Keyword here is example. I didn't research any of these companies. Like I said earlier, I picked shares that are blue chip or large cap companies, meaning their market capitalization is 10 billion rand or more. So there's Clicks with a market cap of 71 billion rand, dividend yield is 1.82%. British American Tobacco market cap 1.6 trillion rand, 6.29% dividend yield. Truworths 19.2 billion rand market cap, 8.89% dividend yield. Kumba Iron Ore 142 billion rand market cap, dividend yield 23.32%. Before you jump on to Kumba Iron Ore because of the dividend, guys, this is not the normal dividend of Kumba Iron Ore. Most likely it was a once off and it'll go back to normal. Next is First Rand Limited, market cap of 350 billion rand, dividend yield 4.97%. Shoprite, market cap 120 billion rand, dividend yield of 2.88%. Sanlam, market cap of 119 billion rand, dividend yield of 6.24%. Vodacom, market cap of 255 billion rand, dividend yield of 6.1%. Spar Group, market cap of 25 billion rand, dividend yield of 5.36%. Vugile Property Fund, market cap of 13 billion rand, dividend yield of 7.81%. MultiChoice, market cap of 53 billion rand, dividend yield of 4.71%. Then I also selected 2 ETFs, Satrix 40, which is a group of 40 South African large cap or blue chip companies. This one pays dividends 4 times a year. Then I also selected the F&B Global 1200 ETF. So it covers 500 companies from the US, 350 companies in Europe, 150 companies in Japan, 60 companies in Canada, 50 Australian companies, 50 Asian companies, as well as 40 Latin American companies. All these companies from all these countries are blue chip companies or large cap companies. F&B Global 1200 also pays dividends 4 times a year. So this is how the dividends would be paid. In January, you would get dividends from Clicks and Satrix 40. In February, you would get dividends from British American Tobacco as well as the F&B Global 1200 ETF. In March, you would receive from Truworths and Kumba Iron Ore. In April, you'd get dividends from First Rand Limited, Shoprite, Sanlam, and Satrix 40. In May, you would receive from British American Tobacco and F&B Global 1200. In June, you'd receive from Vodacom and Spar. In July, you would receive from Clicks, Satrix 40 and Vugile Property Fund. In August, you'd receive from British American Tobacco, F&B Global 1200 ETF, and Kumba Iron Ore. In September, you'd receive dividends from Truworths and MultiChoice. In October, you'd receive from First Rand Limited, Shoprite, and Satrix 40. In November, you'd receive from British American Tobacco and F&B Global 1200. And lastly, in December, you'd receive from Vodacom, Spar, and Vugile Property Fund.
Okay guys, that's it for today's video. If this is your first time on my channel, please subscribe and stick around to watch my previous videos. Until next time, bye guys.